Trump's tariff measures have triggered a global market sell-off. The Wall Street takes it on the chin as well. The Nifty and the Sensex are down over 2.5% this week, with the IT sector seeing some of the deepest cuts. We are talking about, what has been a hugely volatile week in global financial markets, India included. So let's talk about what we're getting you on the show. This is Editors Roundtable. I'm Surabhi Upadhyay. With me, of course, is Rima, Prashant, Nimesh, and we have a very special guest, Prashant Khemka, joining us. And today we're going to talk about a lot of the Trump headlines, the tariff realities, the negotiations that are still ongoing, and what this period of huge uncertainty perhaps could mean for our markets in the days and weeks ahead. So guys, it's a full house, and we have an expert to help us navigate what has been a very stressful week, to say the least, Prashant.
By the way, the situation is so urgent, it has brought Prashant to our studios.
We need Prashant and Prashant. Now, Prashant Square now to solve this for us.
I was joking, Prashant.
Thank you for having me here. Always a pleasure, particularly at such times.
What did you make of it? The entire, should I call it fiasco?
See, I wouldn't say fiasco. Look, he's orchestrated this since a very long time. His views on this subject are very clear. Reality is that US had played a certain role in the world over many decades, big brother kind of role, where a lot of other countries were benefiting from it. You can argue US also benefited. A lot of other countries also benefited from it. Now, let's take NATO as an example. Who needs protection the most? The European countries need the protection the most. But who's spending the most, disproportionately higher, was the US. Yes. So all he's saying is, look, as all our love and affection is on one side, and we continue to have that, but you put up more of your fair share on the table. Yeah? Europeans had, US in any field, most of the fields, been more and more competitive, and Europe on the margin had become more and more laid back. Now this in a way is a jolt to them, and you've seen announcements from Germany and others.
But the question is it a permanent jolt, or is it a...
I think it is a structural. Permanent remains to be seen, but it's structural, because once something like this happens, you cannot say it won't happen again. For many decades, nothing like this had happened, whether it's Republicans or Democrats. Yeah. Now, what if, even if Trump were to, obviously, Trump may stand again, despite the 2 terms. He's talked about, a 3rd term and whatnot. But even if it's not Trump, but someone else, let's say J.D. Vance, he's no different than Trump, and the policies could continue. What Trump's election and his behavior and continued popularity, if it is, what that would suggest to politicians in US is that's the popular mood. And that popular mood may not be just as of then, but maybe more sustainable. And then that politics would be on the rise, and they'll compete, jostle to take that position. Different parties, or certainly Republican Party, different candidates would jostle to take the position of Trump. If they win, they'll continue similar policy. So different countries would have to adjust to Trump politics going forward.
Can I ask one more question, guys? What will take, in your opinion, since US is the problem, US markets are the problem, and the rest of the world is sort of reacting, what will take US markets to stabilize, in your opinion?
I think it might stabilize today or next week, who knows? Because see, the worst news is out. From here, the incremental news is likely to be better. It is not the final statement that is made. It's a negotiation, long drawn out negotiation, and he's made his position very strong on the negotiation table. Now he's going to bilaterally negotiate with his various countries, and will get a better deal for US.
But that I completely understand will hold true if the final negotiated tariff rates come down, if it's not as disruptive. For a second, if we assume and work with the worst case scenario, which was what was announced, then we're talking about a serious impact on inflation, on GDP growth rates, not for us here in India, but around the world. So that has not been priced in the market, or has it?
See, if you take, I have deep respect for the markets. They see beyond the horizon, and maybe they are pricing in, either they might be pricing that these rates would not stick, or if assume that they price in more or less these rates would stick. In that case, if you look at the equity markets plus the commodities market plus the bond markets which have rallied, what they are suggesting is a slower global growth. Seems reasonable. When tariffs, trade barriers increase, growth should be slower, as the vice versa is true, has been true as well. And lower inflation. And lower inflation, why? Because if one hand, if demand slowdown is there, demand for commodities would be lower and whatnot. But also a lot of these tariffs mean additional capacities would be put up in the US. So if steel tariffs have been imposed or any commodity tariffs have been imposed, then steel making units would come up. More steel making units would come up in the US. Overall, steel capacity of the world is increasing then. At a time when demand may or may not slow down. But even if the demand doesn't slow down, the capacity might increase faster. And so that should be negative for steel prices. And that would be deflationary. So I think certain pockets may see, like commodities in this example, price hits. On the whole, I'm not suggesting it will be deflationary, but I think these could imply lower inflation going forward rather than higher inflation.
Very interesting viewpoint, and different from what we've been hearing, the general view. And we'll get into it in more detail in just a bit. I'll quickly take 30 seconds to recap the Indian market action, just the numbers. We obviously got swept up in the global storm, and by the end of the week, it became very, very clear that we cannot remain unscathed. On Thursday, the narrative was that, yes, India is relatively lesser impacted or least impacted. But by Friday, the reality was that financial markets are interlinked, and if there's a global risk off, then we will not be spared. So what's the final tally? For the week, the Nifty is down 2.5%. The mid-cap index is down about 2%. The small-cap index also down about 2.5%. IT taking it on the chin because of the expected uncertainty and maybe delays in business decision-making. So 9% down on the IT index. Metals and commodities pummeled absolutely through and through. The cuts are 7.4% on the Nifty metal index. Oil and gas down 4%. The overall commodities index was also down almost 4%. CPSEs, before this tariff storm hit us, there was a nice wave building towards CPSEs, but all that was, undone in this week. The CPSE index is down about 3.5%. Pharma became the latest casualty on Friday. Till Thursday, the pharma story was very different, but now it's clear that there is no escaping tariffs even there. So that index was down about 2.7%. Financials are emerging as some sort of a mini risk, sort of risk haven or safe haven, so to speak, because IT is not giving you that, FMCG is not giving you that, it's pharma, and therefore the Nifty Bank relative outperformer by being flat, and the Nifty Financial Services Index down just about 1%. Going forward, what the market is watching, of course, is for any further clarity on these tariff headlines, and more importantly, the direction of flows, because March we were celebrating that the FPI selling is over. Guess what? They're back to selling in 4 digits, on most of the days of this week. So that becomes another critical point to watch.
I think apart from what you said, what to look out for, we have a policy next week.
I forgot that.
And
yes,
that will have a big
absolutely.
impact
Yes,
on the financials.
yes,
So
yes,
I just want to ask you, Prashant, given what we've seen in the global context, with a lot of headwinds for the export-oriented sectors like pharma and IT, as a fund manager, would you look to position yourself out of those and move to the domestic players like FMCG and banks?
Certainly. So see, normally, usually we don't do such top-down reallocations. We tend to not take big macro calls on sectoral mix compared to the benchmark. Because it's all relative game. Our sectoral mix tends to be more or less in line with some puts and takes in the benchmark. The idea being to identify better stocks. Now, if it were so that we were very overweight, let's say IT sector, then it is possible we would have reduced that risk at this time, because the uncertainty has shot up so much that it's not prudent from a risk management perspective to have a huge IT overweight. Right now, the domestic sectors are fairly well represented in the portfolio. Because not that we were anticipating something like this or something, but as you might know, we've discussed before, financial sector always has very healthy representation in our portfolio, and that is the case today as well. So be it lending institutions, private banks or NBFCs, they're very well represented. And yes, in general, this is more about trade. So domestically oriented sectors are likely to do better operationally. Now, from a stock return perspective, remains to be seen. Remember, exactly 5 years ago at this time, consensus was pharma is the place to be. For coming years. And pharma turned out to be amongst the worst performing sectors since COVID bottom or COVID hit. We don't know whether we've hit the bottom, but So what the operating metrics do and what the stocks do might be very different going forward in this case as well.
By the way, there's a news flash as we are on. China's imposed extra 34% tariffs on all US goods.
There we
from
go.
10th of April.
It's a full-blown war now. Tit for tat.
Everybody's got domestic constituency, right? I mean, you can't appear to be weak. And as Canada shows, there are some brownie points to stand up to Trump.
Absolutely.
I mean, I think that is the other thing. By the way, on a lighter note, 10 years ago, somebody just sent it to me. This is Donald Trump, exactly 10 years back. He tweeted saying if the Dow ever falls more than 1,000 points in a single day, the sitting president should be loaded into a very big cannon and shot into the sun at tremendous speed. No excuses.
I'm sure people are going to tag him and repost this.
No, we need to adjust for inflation, right? 10 years.
Anyway, let me just go across and what's the thinking from here? That's essentially the question that I'm trying to answer. Over the last 24 hours, by the way, we've heard from many people. We heard from Trump himself. This is after the reciprocal tariffs. They're not reciprocal really, but after the tariffs, the Commerce Secretary has spoken. Treasury Secretary Bessent is on record. And all of them have indicated they're open for negotiations. The problem is, what is the path forward for negotiations? But anyway, let me just quickly talk about this, right? So there isn't any clear indication that Trump and his team are backing down from the proposed tariffs, not at least right now. And this is point number one. They don't want to. It doesn't look like they're waiting, or rather willing to take a small win, which also would be quick. And that's essentially the question that we were discussing earlier. Something very soon, very quickly, somebody offers something and you take it, lower tariffs, etc. The bar seems to be higher. And I think that is essentially the point of these arbitrary tariff numbers they've imposed. So you set the bar very high and then make it really tough for the other party. And of course, I mean, these are points we've discussed earlier. US wants a global restructuring, focus more on changing structural and non-tariff barriers. And it also then becomes a point about credibility, right? I mean, you can lower tariffs, but if you're going to address deeply ingrained non-tariff barriers, that could take years. It may not even be possible. So that is not credible, whereas the market is looking for like a credible, off-ramp from this. I mean, a path out of these tariffs, a way to negotiate out in that sense. Even if all of this were to happen, of course, I mean, Trump himself has said 10% tariffs is the baseline, and that will remain. There is a 400-page report, which, I mean, if you are brave enough, you can read. It's on the internet. It is USTR's 2025 National Trade Estimate Report, and it outlines foreign trade barriers identified on a country-by-country basis. And this perhaps could be one of the things which many countries will use when they go to the negotiating table and start to talk about this. So what are the next steps? The USTR is expected to send a detailed report to the Congress. The Council of Economic Advisors perhaps will tell us how they calculated these proxy tariffs. We know the formula, but the logic behind it, because the logic seems to be we want to eliminate trade deficit, which is just not possible. And of course, I mean, on a practical level, and we'll ask companies this over the next many weeks, goods which are getting into the US at the border, I mean, do they have enough infrastructure to be able to do all this without causing too much business disruption? So far, global reaction, of course, has been measured. I say this even as we just saw the headline that China has imposed an extra 34% tariff. But, I mean, China is large, China is big. But many other countries are just expressing outrage, anger, disappointment, but keeping the room open for negotiations. But this could change, so we'll have to see. So that's broadly the point that I wanted to make. The point being, it's kind of looking, it doesn't look like they're looking for quick wins. So should you expect a quick resolution to all of this? I don't think so. I think it'll take time, and that is the reason why they've kept these tariffs at a very, very high level. Why not take a quick commercial break here? Prashant Khemka is with us. We'll continue this conversation on the other side, and we'll talk domestic. Stay with us.
Welcome back. You're watching Editors Roundtable on CNBC-TV18. Now, the tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year-to-date, the fall is now in excess of 20%, deeply underperforming the Nifty. individual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30, 35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of two reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20, 22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, what, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case. Right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least, say for TCS and Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position. So Prashant, what's the advice for investors who have tech positions, right? Should they just sit tight, wait for this entire thing to play out, or should they actively look at reducing their exposure to the tech sector?
So see, what we are doing as fund managers, we have, as I was saying earlier before the break, we have positions in technology companies, especially mid-cap IT, which we've had for last nearly 8 years now, one full cycle. On the whole, our exposure to tech is not much different from that of the benchmark. Yeah? And we do not take such calls to completely go out or complete overload. We believe we are in companies which over time would outperform the tech sector, gain market share, as these companies have done. They've been volatile. So when COVID hit, there was a dramatic fall in tech sector. One of the worst hit sectors was tech sector, right? Because demand for everything is going to go down, and tech gets chopped in such kind of environment. Obviously, the exact opposite happened. If we had taken a call at that time, exactly 5 years ago, April 4th, today is April 4th, I believe, yeah? April 4th, 2020, it seemed very, very logical that you should sell out a sector like tech and load up on pharma. Everyone's eating pills of one kind or another, whole day staying home. Yeah? And that would have been the most disastrous call. And the hit you take on one such call does not just spoil a year or two. It spoils oftentimes the entire cycle, which can span over a 7-8 year time period. In India, cycles have typically been 7-8 year time period. For some people, such macro calls have spoiled their entire career in life. Yeah? So we just generally refrain. I think from here as well, certain IT companies, we hope and we believe they'll be the ones that we own. They would perform very well. They will gain market share like they did in other past environments, like after global financial crisis. Even then, IT services were supposed to be rooted out because 40% of their business comes from US financials, which was the epicenter
of the crisis.
Of the whole crisis. And yet that year they grew close to double digits. Indian IT sector grew close to double digits. Within that, some companies performed extremely well. Yeah, so I think if you are owning very well performing, high on execution IT companies, I don't see the reason to sell out at this time because you would not know when the environment would have normalized. And you would only know, the stocks would at least have rallied big time before people or investors would figure out that the environment's normalized.
He said the corporate tax cuts are next. I mean, that is going to be a big trigger to juice up the US economy. Whenever that happens, if he says now, markets will start to, feel better.
Could well be. As we were discussing, who knows? And this, look, it's foolhardy to have high conviction or overly confident in matters where, per the nature of the, subject matter, you should not have confidence. Like you can't have high confidence in a coin flip. It would be foolhardy to have high confidence that it will be heads or tails. And most of the macro is of that kind. So you can't have very high confidence. But to me, if you ask, as I was, discussing earlier, it could be the worst point, that the worst news are out. And the news incrementally would be better from here.
Okay, so this is really good, and we're winding up on an optimistic note, because amidst all this, you're actually sounding fairly optimistic to me, which is great. So leave us with maybe some final words of advice. Like you've said, that select IT, you'd still keep in your portfolio. Quick two-part question. How long do you expect this process of repair, recovery, and eventually getting back to the bull market again? How long could it be, best case guess, and what should one do through it?
So I think normal market, if we say, which would be, sideways with some pullbacks of 10, 15%, rallies of 10, 20%. Hard to say when exactly, but it could be that today marks in global markets, it could be that today marks the bottom of this news, for this news. Yeah. Okay. Doesn't mean it would not be volatile and would move back to 0.5% or 1% moves on a day-to-day basis. Hard, very, very difficult to say. I think one should not try to time. If you look back on various such crises, look, compare it to again, going back to COVID, because it's the most recent event that everyone would remember for the rest of their lifetime. Because there was no event worse than COVID in our lifetime.
Yeah.
True. And think of the damage that COVID caused in real life.
Yeah.
There's no other event in real life that has caused more distress, more damage than COVID. And think of what impact it had on markets. Yeah. It was one of the best years, 2020.
It was a V-shape, which was my question. COVID was a dramatic V-shape.
In the markets.
In the markets.
The real economy did
absolutely
endure a lot of pain.
In November of 2020, it was that Pfizer vaccine, right?
Yeah.
Which is the point when the markets took on. What is going to be that point now? Maybe, I was saying on closing bell, we're maybe one headline away from market stabilizing.
The tax cuts?
Absolutely.
You just need cuts that you're talking
not
about?
Tax cut. I think you need something, they have to say this is how you can negotiate and this is how tariffs can be brought lower, because right now we don't have that clarity. You can't say 52% and then expect, the entire deficit to be wiped off. That's not going to happen. So you just need that clarity and it'll come. Maybe the US falls a little bit more. Maybe that happens.
The one announcement that is negotiated with one country of size, and they've settled for somewhat lower tariff.
Yeah.
That would tell the world that
formula for everybody.
Yeah, formula for others to follow.
Yeah.
Clearly, China is not following it. Not right now, given the headline that we just saw. But anyway, it's an interesting world, to say the least. Prashant, it's been such a pleasure to have you here with us to talk about this. And we hope to see you more often, as and when possible, in our studios. Thank you so much for joining in. Thank you very much.
Thanks.
Well, all right, folks. With that, I think it's time for us to say goodbye as well. It's a wrap on this edition of Editors Roundtable. Thank you very much for watching. See you bright and early once again with the markets on Monday morning. Till then, news and views continue on CNBC-TV18.